The stock market is currently closed for the weekend following the last live session on Friday, May 22, 2026. The final recorded closing price for Nokia stock, trading under the ticker symbol NOK on the New York Stock Exchange, stands at exactly $15.47 per share, marking a massive single-day intraday surge of 9.10%, alongside an extraordinary trading volume of over 126 million shares. Now, when most retail investors look at Nokia stock today, they see a relic of the early 2000s, or perhaps a slow-moving European telecom firm tethered to the capital expenditure cycles of cellular carriers. But the reality that unfolded in the public markets at the end of this week completely shatters that stale narrative. The massive volume breakout and near vertical price action were triggered by something completely unexpected by the broader public. Nokia officially opened its brand new Artificial Intelligence Network Innovation Lab in Sunnyvale, California, revealing an enterprise partner list that reads like a who's who of Silicon Valley powerhouse firms, including Advanced Micro Devices, Lenovo, Supermicro, and NVIDIA. While everyday traders are busy hunting for the next hyped-up microcap chip designer, institutional funds are quietly realizing that the massive computing clusters being built worldwide are fundamentally bottlenecked by data transmission infrastructure, and Nokia has positioned itself directly at the center of that physical layout. This creates a compelling friction between general market expectations and structural reality. The common consensus on Wall Street for years has been that telecom equipment providers are low-growth, low-margin utilities destined to suffer as major mobile networks slow down their spending on physical hardware. Investors assumed that the capital expenditure boom in the technology sector would exclusively flow to semiconductor manufacturing and hyperscale cloud data centers. The deeper structural analysis tells a completely different story. The massive datasets required for modern software models cannot operate in isolation. They require immense optical bandwidth and specialized IP routing systems to move data between server racks without introducing latency. Nokia's recent corporate activity, specifically its massive multi-billion-dollar acquisition of optical networking specialist Infinera, shows a deliberate pivot towards this exact high-margin enterprise domain. When you look at the raw transactional data from the latest session, the stock did not just move up on speculative retail hype, it experienced a systemic institutional re-rating. Wall Street firms completely overhauled their valuation models in a matter of hours. Morgan Stanley dramatically raised its price target for Nokia to $16.50, explicitly labeling the company as their top pick in the networking sector, and pointing to a staggering 49% year-over-year surge in net sales to cloud and enterprise clients. At the same time, CFRA upgraded the stock from a hold to a clear buy, more than doubling its long-term target to $16, by arguing that the company should no longer be valued like a legacy hardware vendor, but rather like an optical infrastructure peer. Bank of America similarly adjusted its stance, moving to an outright buy rating based on the structural margin expansion hiding within the enterprise division. This creates an intense curiosity loop, because the broader public still views this asset as a sleepy $5 dividend stock, completely unaware that it has surged well over 100% since the start of the year, tracking a multi-month upward trajectory that recently culminated in this fresh 52-week high. To understand why this momentum is catching fire right now, you have to look closely at the underlying financial performance and immediate macroeconomic drivers. In its first quarter financial disclosure for 2026, the company posted a massive expansion in its comparable gross margin, which grew by 320 basis points to reach 45.5%. Even more telling was the management's decision to aggressively upgrade their full-year revenue guidance for the network infrastructure division, raising expectations to a growth rate of 12 to 14%, fueled by a blistering 20% growth rate in their optical networking unit alone. During that single quarter, the company secured roughly €1 billion in net new infrastructure orders, specifically tied to enterprise computing demands. This is where online investing platforms and modern trading apps have seen massive spikes in liquidity. If you monitor order flow on popular online investment tools or track retail sentiment across popular investing sites, you will see that retail capital is finally starting to chase the trend that institutional asset managers initiated months ago. Whether you look at individual brokerage accounts at legacy firms like Fidelity Investments or check user positioning on modern platforms like the Robinhood app, the accumulation patterns are clear. Investors are searching for tech-adjacent assets that haven't been completely blown out to unsustainable valuation multiples. While a standard individual brokerage account holder might be hesitant to add capital to mega-cap chip stocks trading at 50 times sales, Nokia's sudden fundamental shift offers a stark contrast, a highly profitable, cash-generating business that is suddenly experiencing a massive structural acceleration. Comment below how many shares of Nokia stock you currently hold in your portfolio, or if you prefer trading other networking names instead.
If we look at the specific competitive landscape, this massive weekly movement was also heavily supported by broader industry readouts. Earlier in the month, networking titan Cisco Systems posted an exceptional quarterly earnings report, showing a 25% surge in enterprise networking revenue. The market immediately realized that the spending boom isn't just a local phenomenon, it is an industry-wide capital wave. When Cisco's numbers validated this massive demand, funds immediately began scanning the sector for undervalued competitors with advanced physical engineering capabilities. Nokia stock instantly became a primary beneficiary. This structural reality has led to massive options volume and heavy accumulation across various self-investing accounts and retail platforms. Users exploring SoFi Invest or managing assets through interactive brokers trading platforms are witnessing a significant migration of capital out of highly speculative software names and into tangible, physical layer technology providers. The company's ongoing technical collaboration with NVIDIA to test GPU-powered radio access network solutions with global operators like T-Mobile, SoftBank, and Vodafone shows that this isn't just about selling traditional fiber cables. They are building hybrid infrastructure where artificial intelligence tasks and traditional communications workloads run simultaneously on the exact same physical server architecture. This completely changes the long-term margin profile of the business, shifting it away from the highly competitive low-margin bidding wars of the telecom space and moving it into premium enterprise software and specialized compute configurations. Let's ground this entire thesis by looking at exactly what this company does and how its business model has shifted over time. Headquartered in Espoo, Finland, the modern iteration of Nokia is focused entirely on three core pillars: network infrastructure, mobile networks, and cloud and network services, alongside a highly lucrative patent licensing division known as Nokia Technologies. For years, the legacy mobile networks division was an expensive anchor on corporate performance, forcing the company to engage in capital-intensive regional deployments against brutal global competition. However, the corporate strategy completely shifted over the past 24 months. Management began aggressively allocating capital away from traditional mobile masts and channeling it directly into high-capacity optical networks, automated IP routing, and advanced fixed wireless broadband technologies. They currently support over 600 million broadband lines globally, giving them a massive installed base to cross-sell the latest automated network diagnostic tools. They have even formed deep defense sector integrations, partnering with Lockheed Martin to deliver secure, modular 5G solutions built specifically for the United States Department of Defense, demonstrating that their engineering capability extends far into high-security government infrastructure. This legacy foundation provides a stable floor of predictable cash flow, which is exactly why the company managed to generate 600 million euros in pure free cash flow in the first quarter alone, long before the recent revenue acceleration fully hit the ledger. As we look out toward the remaining quarters of 2026, the forward-looking outlook will be defined by how cleanly reality can continue to outpace the market's evolving expectations. The primary near-term catalyst to watch will include the formal integration of the Infinera acquisition, subsequent quarterly execution reports from optical hardware peers like Ciena, and potential inclusion in major European equity indices this autumn, which could spark massive automated index buying. However, the path forward is not entirely without risk. The primary threat to this bullish thesis remains the ongoing sluggishness in traditional telecom provider capital expenditures. If major cellular networks cut back their legacy mobile spend faster than the high-margin cloud division can scale, it could create near-term revenue friction. Furthermore, navigating complex cross-border trade policies and sustaining heavy research expenditures across both European and North American facilities will require flawless operational execution from the management team. In summary, the dramatic market action we witnessed at the end of this week represents a fundamental structural re-rating of a business in transformation. The old market narrative painted Nokia as a stagnant, low-growth equipment supplier, bound to the capital constraints of global telecom carriers. The hard reality revealed by recent financial reports, major institutional upgrades, and the launch of the California laboratory shows a highly profitable infrastructure leader capturing a rapidly growing share of global enterprise data traffic. While the general public is still waking up to this transformation, the massive institutional volume and surging stock price suggest that the smart capital has already made its decision, recognizing that the global digital build-out cannot function without the physical and optical connectivity that Nokia provides. Ensure your personal investment decisions are always backed by thorough individual analysis and risk tolerance planning.